Thank you for joining us. Welcome to Business Incorporated. I'm Chimeze Obi Iwago. On the show today, U.S. President Donald Trump bets on Kenya for Africa trade pacts as negotiations begin. World Bank expects Uganda's growth to sink as low as 0.4% this year. And biggest Zimbabwe bank to buy small lenders in consolidation push. We'll begin the show with intraday market numbers. And here in Africa, they were mostly positive, with South Africa's JSE index surging 1.05%. Nigeria's main index was also in positive territory by 0.13%, led by banking stocks. On the flip side, Egypt's EGX30 shaved off 1.62% at intraday. Kenya closed negative on Wednesday. And market sentiments in the Gulf region were mixed at intraday, with the Qatari index gaining the most by 0.99%. Saudi Arabia's stock market added 0.55%, driven by a 0.4% gain in Al Rajhi Bank and a 1.5% rise in Saudi Arabian fertilizers. Elsewhere in the UAE, the Abu Dhabi index eased 0.38%, hurt by a 0.5% fall in Emirates Telecommunications and a 3.7% decline in Waha Capital, while Dubai's main share index slipped 0.05% at intraday. And in Europe, markets edged higher this morning as investor focus swings to the potential economic recovery and earnings season gets underway. There are also a couple of other stories making the rounds, and Conrad will tell us more. Hello, Conrad. Good afternoon. Thank you for being with us again.
Good afternoon, Shivi. Thanks for having me back on Channels TV. Great to be here.
So let's talk about the WTO first. The application period for the post of Director General of the World Trade Organization ended last night. At the last minute, several new candidates entered the race, where so far Nigeria's ex-finance minister, Ngozi Okonjo-Iweala, was perceived to be a front runner. Who are the people betting on in Frankfurt?
Well, if you talk to people here, even though a number of new candidates have entered the race at the very last minute, your ex-finance minister, Ngozi Okonjo-Iweala, has still a very good chance to become the new WTO chief. She just has an impeccable CV, an impeccable resume. And, you know, coming from Nigeria might be an asset too, because Nigeria, unlike Europe, unlike China, unlike parts of America, South America or Canada, has no trade spat with the US President Donald Trump. And of course, the Americans are crucial in this game here. It's very important to get them more interested, more committed in the WTO again. And a candidate coming from Nigeria, a woman from Africa, might just be the right person to do that. Another interesting candidate is, even though he's a bit of an old white man, is the candidate from Mexico, Jesus Seade. He's very experienced when it comes to negotiating trade deals. He just recently was part of the team that negotiated the new trade deal between the US, Canada, and Mexico. And some people I talked to here believe that the visit of the Mexican President López Obrador to Donald Trump in Washington yesterday also happened because the Mexican president was set to advertise his Mexican compatriot to lead the WTO. Here too, there's reasoning that has to do with the North Americans. If they back a candidate, maybe from Mexico, then it would be positive for the organization itself. Not a big chance, at least if you discuss it with people here in Frankfurt, is the candidate from the UK who just entered the race yesterday. It's Liam Fox. He used to be the trade minister under Theresa May, then was sacked from the cabinet by Boris Johnson, and he always has been a strong supporter of Brexit, so he would probably not get the backing from the European Union and its most important member countries, including Germany.
Anyway, let's wait and see who emerges the winner at the long run. Let's look at the market. The stock market in Frankfurt today is recovering somewhat, despite German export numbers showing a 30% decline year on year in the month of May. What silver lining are investors seeing there?
Well, the silver lining is the micro picture, if I might call it that. Compared to last year, the slump in exports is heavy. But if you look at the month of April this year and May this year, then the recovery continued. It was not a big recovery in exports, but it was still there, and it underlines that, the recovery after the corona lockdown is intact. That's also underlined by data coming in from the OECD today, the Organization for Economic Development and Cooperation. The so-called early indicators came in quite strong. And last but not least, we have SAP here in Frankfurt today, the large software firm which presented a very strong second quarter earnings report. It was so good that SAP came out with it ahead of the originally scheduled time. The operating margin has risen to around about 29%, very profitable company, and that is pulling upwards the share price of SAP as well as the German index DAX.
And to some corporate news there, Germany's technology group Siemens had an extraordinary shareholders meeting today, a virtual one. Why that meeting, and what's traders' take on it?
Siemens is spinning off its energy unit, which consists of about 1/3 of its business and is actually representing parts of the origins of the company itself. In the 19th century, Siemens was one of the first companies here in Germany to provide technology for power plants, now a spin-off. This company and this unit also consists in large parts of technology used in power plants that are driven by fossil fuels, by gas and coal. So there is a little bit of a discussion going on among traders whether it's really a good idea to do it and whether it will be really welcomed by investors. Arguments in favor of the spin-off are that the business also consists of the wind energy business, which is called Gamesa and which is, very future-oriented. And traders explained to me that after a spin-off, this new unit has many more strategic opportunities than it has at the moment. For example, a merger with a competitor would be a possibility, and that is something that many traders believe makes sense in terms of an investment story. In terms of the rest of Siemens, the part that is still going to be called Siemens in the future, and that will consist of the digitalization business, the railway train unit, and also the medical technology business. The standing of this remaining part of Siemens on the financial markets will be much stronger after the spin-off of the old energy unit.
Conrad, just one date, then we can say, thank God it's Friday. Enjoy the rest of the day. And in the UK, many retailers have continued to close shop and laying up thousands of workers. And the latest is John Lewis. Let's get Juliana to tell us more. Hello, Juliana. Good afternoon. So what reactions are you getting there about John Lewis's announcement that it is permanently closing 8 of its stores, putting 1,300 workers at risk?
Good afternoon, Chimi. Nice to see you. This is a major story, as you can imagine. John Lewis is a really famous department store. Just it's a stone's throw away from where we are in the centre of London, and even that store hasn't been opened. It will be opening, I suspect, within the next couple of weeks. And there had been some long rumours stirring around John Lewis and how many of their department stores will close. So they have made the announcement that 8 department stores will close. One of them are in Heathrow Terminal 2. There's another sort of travel hub, John Lewis, that will also be closing at St Pancras Station, as well as in Croydon, which is the south of London, and in Birmingham. And of course, there are others. That is going to be putting thousands of jobs, just under 2,000 jobs at risk. We do actually have a statement from John Lewis, from Sharon White, their CEO. She says, prior to the pandemic, the 8 shops identified were already financially challenged, and the pandemic has accelerated the switch from shopping shopping to shopping online. They also added, if redundancies are confirmed, every effort would be made to find new roles where possible for partners who wish to remain within the partnership. Opportunities will be available in their local Waitrose stores. Just before I came into the studio as well, we do have another really big retailer, Boots, known for medicines and pharmaceutical products as well as beauty and fragrance. They've announced that 4,000 jobs will be going. They are going to be closing 48 stores, which is a huge amount. In fact, that actually trumps the amount of redundancies that John Lewis will be making. They said they are going to be focusing on reshaping the head office and that the system has changed. And this is a major blow, particularly to the government, because, of course, just 24 hours ago, in fact, exactly 24 hours ago, the Chancellor Rishi Sunak announced a series of measures, £30 billion worth, and he started off that speech at the dispatch box saying that he was trying to protect jobs, that by offering this £1,000 retention bonus to employers, that he would be able to maintain jobs. But for companies like John Lewis and Boots, that £1,000 per employee just wasn't enough. So yes, that's a major business story here in Britain this afternoon.
And I must say, it's really not a good time for Rishi Sunak. Anyway, the Institute of Fiscal Studies think tank says the economy will remain in a support and recovery phase for some time, but higher taxes are inevitable. Are taxpayers prepared for the day of reckoning?
Oh, gosh, I don't think so, Chimmy. Nobody wants to pay higher tax, do they? But it's a good question because I think people are. A lot of the commentators that were analysing Rishi Sunak's speech yesterday said it's all well and good giving people £10 to go and eat out or £10 off a meal when they eat out. But are people going to spend that money when they know that higher taxes are on the horizon? Are people going to start spending on brand new clothes when they know they're going to have to pay more for that in a couple of months' time? And this is really what the IFS are saying. The IFS, really well-known, prominent think tank that looks at fiscal and tax here in Britain. And they're saying that with all of this money that Rishi Sunak is spending, it's inevitable that higher taxes will be coming in the short amount of time. At the moment, the government have already spent £190 billion in COVID support. They expect that figure to rise to about £300 billion this year, about £150 billion next year. So £500 billion is what they expect the government will spend, which is about 18% of GDP. And this is worrying some Conservatives. So on the one hand, you've got a lot of people that are already tipping Rishi Sunak to be the next Prime Minister because he has delivered, well, some would say he's delivered, where nobody thought he could in a new position. But on the other hand, he is really sounding like a Labour Chancellor, you know, for the Tory government who have had 10 years of austerity measures to be throwing money, literally some people would say away, is completely unheard of. And this is worrying some Conservatives because we know historically or traditionally Conservatives do not like to pay higher tax. We heard from Sajid Javid, his predecessor yesterday, who commented after his speech saying that the government really needs to start now focusing on the government's debt levels and how they can reduce it because inevitably nobody wants higher taxes. And at the moment, it's great that the government are giving away all this money. But when it comes to the time when people have to pay it back, they could lose their traditional support system.
Well, Juliana, a quick one on another development. The UK energy watchdog, Ofgem, has unveiled a £25 billion green investment plan meant to improve Britain's energy infrastructure. How will this impact your energy bill? And which of these headlines we've talked about are market movers today?
Unfortunately, it's not going to affect me too much, I would say, Chimaze. £20 a year. You know, I'll take anything off my energy bill. But for each customer, I don't think it's going to be an effect. But this has really caused a major row between the energy giants. They are not happy at all. And they've been on the media talking about just how bad this scheme is for Ofgem. Basically, what the industry regulator is trying to do is to prevent or reduce the amount of dividends that these energy companies are paying to their shareholders, and to reduce the amount of bills that people pay by capping bills at a certain price, which could save each customer about £20 a month. They've released statements saying that they're not happy, that they say Ofgem are trying to do this £25 billion green bill, but in effect, it's going to cause more problems for the energy giants. It'll be interesting how that develops. Quickly look at the numbers. The all-share is down 0.40% at intraday. The FTSE 100 is down by 0.5%. The FTSE 250, the domestic market, is up. In the currencies market, the pound is up on the US dollar, also up on the euro, and up on the Japanese yen at intraday. Thank you, Chimi.
Thank you, Juliana. Let's continue to track those developments there. Enjoy the rest of the day. And when we return after the break, we'll talk commodities. Do stay with us. On commodities market update, our focus is on gold as the bullion held steady above the key $1,800 an ounce level this morning, as worries over mounting COVID-19 cases offset hopes of a swift global economic recovery. Spot gold was little changed at $1,808 per ounce after rising to its highest level since September. U.S. gold futures were flat at $1,819. Now, joining me now to talk more about this development in the metals market is Nneka Okolo, one of the research analysts with Financial Derivatives Company. Hello, Nneka. Good afternoon. Thank you for joining us.
Hello, good afternoon. Thank you for having me.
Now, in times of uncertainty, there are usually a flight to safety at times exemplified by holding gold. Now, the price of gold has jumped by over 60% since 2015. Do you think this price increase is reflective of the global risk and uncertainty, or is it due to fundamentals?
Well, gold has sustained a progressive year-on-year growth since 2015, well, with the exemption of 2018, when the price declined by nearly 2%. Notwithstanding, a good portion of this cumulative growth of 68% was occurred in just the first half of 2020. But what are the highlights? We are aware that the highlights for this year so far range from the widespread border closure to the World Bank's forecast of a 5.2% decline in the global GDP. So given this, we have seen that the price of gold increased due to investors' demand for the safe haven metal amid the coronavirus crisis. So definitely, the sharp price increase in gold is more reflective of risk and uncertainty than of fundamentals.
Traditionally, there is an inverse relationship between the price of gold and the value of the dollar. But recently, there have been times when both have moved in the same direction. Is this a new phenomenon? And are we to assume that the normal inverse relationship is no longer valid?
First of all, the inverse relationship between the price of gold and the value of the US dollar follows from the fact that gold is by default priced in US dollars. So a stronger dollar would imply that the commodity would be more expensive in other currencies, and in turn influence demand in the sense that it could cause demand to decrease. But it could cause demand to decrease and cause prices to go lower due to gold's positive price elasticity feature. Now, because there are other economic factors that come into play during the decision-making period. For example, employment levels, if there was economic growth or a contraction, or the inflation rate. As we have seen before, the price of gold may higher gold prices may not imply lower demand. In this sense, we'd see the price of gold move in the same direction with the value of the dollar. So what I'm trying to say summarily is that the inverse relationship between the price of gold and the value of the dollar does exist. However, because there are other macroeconomic conditions that come into play, the relationship may not always hold.
Now, Nigeria has started gold production, especially in Zamfara State, but there has been major crises in that zone, including banditry and killings. Do you think that Nigeria can actually benefit from the new surge in the price of gold? And how do you think we can insulate gold production from the local crisis?
Illegal mining in Zamfara, one of Nigeria's gold-producing states, gave rise to local conflicts, which led to the federal government's ban of gold mining activities within the state and its environs in 2019. Since then, the most significant progress we've seen in Nigeria's gold mining sector, gold mining industry as a whole, is the inauguration of the gold refinery that occurred last month. So while this gold refinery is on their way to begin production and forecasts for gold prices still remain optimistic, we'd expect that Nigeria would eventually benefit from the surging price of gold. A way to ensure gold production in Nigeria would be for the government in collaboration with state governors to enforce laws that target, first of all, the security of the inhabitants of those states, and secondly, reduction of illegal gold mining in the states, in major gold producing states in Nigeria.
All right, thank you very much for your time, Nneka Okolo, one of the research analysts with Financial Derivatives Company. And the U.S. and Kenya have started negotiating a free trade agreement, paving the way for President Donald Trump's push for bilateral pacts in Africa. Trump is moving to reset U.S. trade relationships with regions and nations across the world, including Mexico, Canada, China, Europe, and the UK. In sub-Saharan Africa, he prefers bilateral agreements to the African Growth Opportunity Act, which allows about 6,500 products from 39 nations preferential access to the U.S. and expires in 2025. The U.S. sells products including aircraft and equipment to Kenya, while the East African nation ships textiles, flowers, fruit, and vegetables. Kenya, which is the largest supplier of flowers to Europe, wants to rapidly increase the shipments of blooms to the U.S. And the World Bank expects Ugandan economic growth to plunge to as low as 0.4% in 2020 from 5.6% last year, as the coronavirus crisis batters the East African economy ahead of presidential elections set for 2021. The pandemic is expected to hit tourism, exports, and remittances. It is also likely to damage investments in the country, where long-awaited oil production could commence by 2022. The fiscal deficit will rise to between 7% to 8.9% of GDP next year, from pre-COVID-19 levels of 5.8%. Zimbabwe's biggest bank, CBZ Holdings Limited, plans to buy several smaller lenders in a consolidation drive to leave the troubled Southern African nation with fewer, stronger institutions. CBZ Holdings Limited, majority owned by the government, is in talks with the Reserve Bank of Zimbabwe over the acquisitions. Under the consolidation push, the authorities are seeking to cut the number of banks down to 6 or 7 major players from 21. Zimbabwean lenders are struggling to survive in a shrinking economy. The country is battling severe cash shortages, rampant inflation, a depreciating currency, and a lack of confidence among depositors because of frequent policy changes. And that's a wrap on the program. Thank you for watching. I'm Chimeze Obi Iwagu.